The merits of dividend investing seems to spark a lot of debate. Some say focusing on dividends holds you back, arguing that growth funds are where the real wealth is built. Others swear by the steady income dividends provide. But what's the truth? In this video, I'll break down the pros and cons of dividend investing so that you can make an informed decision about whether it's the right strategy for your financial future. Now, one of the arguments against dividends is the idea that it's not free money and it hurts the share price. In theory, this is true. Think about your own finances. If you constantly paid cash to family members, your net worth would decrease. It's really no different for a company. Let's do a quick rundown to see how dividends basically work. Let's say a company has 1 million shares owned by its shareholders, and it generates $4 million in earnings. That equates to $4 per share of earnings. If the company doesn't pay any dividends at all, it gets to keep the $4 million to reinvest and grow the business. However, if it decides to pay a $3 dividend, it gives $3 million of earnings to the shareholders and only keeps $1 million to reinvest. When the company pays that $3 dividend, it reduces its cash reserves by $3 million. This decrease in the company's total assets is reflected in the lower market value, and that's why the share price adjusts. For example, if the stock was trading at $50 per share, in theory, the price would drop by $3 to $47 per share after the dividend is paid. For relatively small dividends, the price drop can be harder to observe because it's overshadowed by other market factors, like current news of the day or investor sentiment. But in principle, every dividend payment reduces the company's assets, and that reduction is reflected in the stock price. One way to think about dividends is to consider who gets to decide how the company's earnings are spent. A company that doesn't pay dividends at all may choose to reinvest all of its available capital into growing the business, aiming for higher long-term returns. However, in our example, where the company paid out a $3 dividend, the shareholder gains control over how some of those profits are used. For instance, if a shareholder owns 1,000 shares, they would receive $3,000 in dividends. They can then decide what to do with that money. They may want to supplement their own income, reinvest it back into the same company, or explore other investment opportunities. Dividends give shareholders direct access to a portion of the company's profits, allowing them to tailor their financial strategy to their own personal goals. Now, if the stocks are held in a personal brokerage account rather than a retirement account, the shareholder would owe taxes on those dividends. But that's kind of the price you pay for the flexibility of getting to decide how to spend some of the company's profits. Another common debate is whether you should just focus on the overall returns. Total return includes the dividends you're receiving plus the increase in share price. After all, if you're getting a 5% dividend but the stock price drops 10%, your total return is negative. So this is a pretty solid argument. Think about it. Some of the best performing companies in recent years have been in the tech sector, and many of them don't pay a dividend. Take Amazon and Tesla, for example. Neither pay a dividend, yet over the past 10 years, ending in 2024, Amazon has delivered an annualized return of around 29%, and Tesla has averaged around 39%. These are typically considered growth stocks, and many growth-focused ETFs like QQQ or SCHG include Amazon and Tesla among their top 10 holdings. But growth stocks come with more volatility. For example, in 2022, when the S&P 500 dropped 18%, Amazon fell nearly 50%, and Tesla dropped 65%. Since most mistakes investors make are emotional ones, this level of volatility can bring its own risks. That's why For most investors, I believe they're better off sticking with index funds and other low-cost ETFs rather than pick individual stocks. Let me take a quick moment here to say I'd really appreciate it if you could hit the like button and leave some comments below. It really does help the algorithm and supports the channel. Okay, now let's take a closer look at some of the pros and cons of dividend investing using index funds rather than individual stocks. For the first comparison, let's take a look at Schwab's popular dividend-paying fund SCHD and their growth fund SCHG. As a benchmark, I'll also include the S&P 500. When we look at the performance, assuming dividends are reinvested, over the 10-year period ending in December of 2024, SCHD had a compounded annual growth rate of about 11%. The growth fund SCHG returned 16.7% and the S&P 500 came in at 13.01%. If you were purely focused on growth over a long period, the growth fund certainly comes out on top, at least over this time frame. After all, it's called a growth fund for a reason. However, with the potential of higher returns comes much greater volatility. Over that same period, SCHD's worst year saw a decline of 5.56%, while the growth fund dropped 32% in its worst year, and the S&P 500 in comparison fell 18% in its worst year. Such volatility can cause sleepless nights for some investors and might lead to poor emotional decisions. For one more comparison, let's take a look at Vanguard's VIG, the Dividend Appreciation Fund, VYM, their Dividend High Yield Fund, and VUG, their Growth Fund. Again, over the same 10-year period, the Growth Fund easily wins with a rate of return of 15.75%. The Dividend Appreciation Fund, VIG, comes in second with 11.38%, and the High Yield Fund comes in third with 9.77%. However, just like before, the Growth Fund experienced much more volatility, with its worst year dropping 33%. We do need to remember that for most of that 10-year period, we had below normal interest rates and other macroeconomic events fueling economic growth in the U.S. This type of environment favors growth companies. So let's take a look at the 10-year period finishing up in December of 2010. This is sometimes referred to as the lost decade for stocks. So I can use low-cost funds that existed during these years. I'm going to use VDIGX, that's Vanguard's Dividend Growth Fund, VIGAX, Vanguard's Growth Index, and VFIAX, Vanguard's S&P 500 Index. Here, the dividend fund slightly outperformed with an annual rate of return of 1.8%, and the other two came in at 1.4%. This was a tough decade for anybody invested in stocks. However, funds focused on small cap, mid cap, and emerging markets actually held up quite well during this period, which makes a strong case for having some diversification in your portfolio. Now, looking at the worst years in this 10-year period, the dividend fund dropped 25%, while the growth fund fell 38% and the S&P 500 declined 37%. Incorporating dividend-paying stocks can add a layer of diversification to an investment portfolio too. These stocks belong to different industries such as utilities, consumer staples, and healthcare, which can behave differently from high-growth sectors like technology. This diversification can help mitigate risk and smooth out overall portfolio performance during market volatility. For example, in 2022, the S&P 500 dropped 18%. A fund like QQQ dropped 32.58%. Schwab's Dividend Fund, SCHD, only dropped 5.56%. Now, so far, I've just been covering some of the math about the two philosophies. But investing isn't just about the math, and there's no such thing as a perfect portfolio. Always remember that nobody can predict the future. People often choose dividend investing over growth funds for entirely different reasons. They might be more risk adverse and prefer funds with lower volatility, or they may just like the idea of generating an income stream. There is no single right way to invest. Every strategy has its potential rewards and inherent risks. The best approach for you depends on your own personal goals, financial circumstances, and risk tolerance. Some argue that instead of focusing on dividends, you could just sell some of the stock when you need some money. But this can create additional stress for some people, as it often requires trying to time the market during fluctuations. Dividend investing helps reduce this need by providing regular cash payments, regardless of the stock price movements. By focusing on dividend income, investors can adopt a more consistent strategy, relying on steady flow of dividends to support their financial goals, irrespective of short-term stock market changes. Here's another interesting perspective on the benefits of dividend funds. Companies that maintain or grow their dividends are often celebrated. Members of the S&P 500 that have increased their dividends for at least 25 consecutive years are known as dividend aristocrats. From 1990 to 2023, the S&P 500 dividend aristocrats outperformed the S&P 500 nearly 70% of the time during the months when the S&P 500 was negative, and around 44% of the time in months when the S&P 500 was positive. Overall, the dividend aristocrats outperformed the S&P 500 in about 52% of those months. According to J.P. Morgan, the most common mistakes investors make is cashing out when market gets volatile, followed closely by trying to time the market. This is where dividend investing can offer a psychological benefit. Focusing on dividends can help investors stay committed during market fluctuations. Plus, in a bear market, the lower volatility dividend stocks will likely outperform growth stocks as more investors seek income and shelter. Plus, reinvesting dividends allows them to automatically purchase more shares during market downturns, taking advantage of lower prices. A recent survey also revealed that 66% of investors admitted to making emotional decisions they later regretted. Because of emotions and the fact that everyone has a different personality, what works best for one investor may not be the best approach for somebody else. It's important to understand this and align your investment philosophy with your risk tolerance and overall goals. Remember, investing isn't just about the math. You can't control the ups and downs or the unpredictable events that's going to happen in the world. But you can control your savings rate, emotions, and the risks you take. The best plan is usually one you'll stick with through any volatility. Now, there's nothing wrong with using both approaches. Incorporating a growth fund in your portfolio alongside a dividend-paying fund. For example, Schwab's dividend fund, SCHD, only has about a 7% overlap by weight with the S&P 500 and very little overlap with most growth funds. You can allocate a portion of your portfolio to growth funds for long-term capital appreciation while dedicating another portion to dividend funds which provide diversification and stability. A dividend-paying fund isn't necessarily designed to deliver the best returns over a long period of time. Instead, it aims to gradually build your income stream that helps you meet your life goals. So, let's say you like the idea of dividend investing. Here are a few things to keep in mind. First, for most long-term investors, your dividends come from a personal brokerage account will be taxed as capital gains rather than ordinary income. However, be careful if you're an active trader, as this can prevent you from qualifying for that favorable tax treatment. And then, If you're looking for individual stocks, be careful of high yields. A high yield is often the result of a declining stock price or silly financial engineering, both of which can lead to higher volatility and risk. As a stock price drops, its dividend yield increases. Take Verizon, for example. As I record this video, its dividend yield is over 7%, but the stock price has dropped 34% over the past 5 years. During the same period, the S&P 500 had a compounded annual growth rate of 14.54%. Many rookie investors get drawn into a stock solely because of its attractive dividend yield. Again, I believe most investors would benefit from using index funds and other low-cost ETFs rather than pick individual stocks. But that relationship between stock prices and the yield can easily be observed in the S&P 500 also. Check out this chart. You can see that during market crashes, such as the one we experienced in 2008, the dividend yield of the S&P 500 spiked. As we enter a bull market and stock prices rise, the yield tends to decrease. Take, for example, an individual company. Let's say it pays a $2 dividend per year and the stock price is $50. Dividing 2 by 50 gives us a 4% dividend yield. If the stock price jumps to $80, the yield becomes 2 divided by 80, or 2.5%, for the same $2 dividend. On the flip side, if the stock drops to $20, the yield becomes 2 divided by 20, or 10%, for the same $2 dividend. So here are some general rules of thumb. When an investor is younger, as long as they can avoid emotional mistakes during periods of volatility, investing in growth stocks or something broad-based like the S&P 500 tends to provide more capital appreciation over the long term. After all, earning dividend income isn't crucial when you have income from your job. However, once you are retired or nearing retirement, you might consider shifting towards more dividend-paying stocks for income. Once you've grown a sizable financial nest egg, your goal might shift more towards capital preservation. So I hope you feel this has been a balanced look at some of the pros and cons of dividend investing. I would sure love to hear your thoughts. Thank you for watching.